But I do think it's kind of interesting that no politician really has any interest in seriously lowering our debt limit. In fact, nobody in Congress has interest in lowering debt, as David Freeberg talks about all the time. There's just no motivation. So it is a sad state of affairs, if you ask me. Has the Sell America trade started again? If you don't recall what the Sell America trade is, it first started after Liberation Day, where the dollar went down, bonds went down, rates went up, and gold took off. The whole idea is that folks were less interested in holding U.S. assets, specifically treasuries. And as you probably heard on Friday after hours, we had the third and final major U.S. credit rating agency downgrade U.S. debt. We now have gone from AAA to AA+. What does it mean? Well, I think it does a couple of things. First and foremost, I think the first downgrade of the U.S. debt was far more significant. When we put the chink in the armor, I think it was 2011, 2012, that was significant. If you go back and look at the charts, as we did yesterday with Mr. Dan Bird, that was a bloody day, if memory serves, over 5%. Then the second downgrade coming 2021, 22, something like that. Not as much of a hit. The third downgrade, fully expect the morning sell-off as people reposition themselves. However, I think the close is far more important than the open. Does the negativity continue? Were we set for a pullback after 5 positive days and near all-time highs? We shall see. For me, and likely for you, I am most interested in interest rates. And as of this morning, I haven't checked in the last half hour or so, the 10-year note was back above 4.5. Last I saw was 4.54. But probably more meaningful, the 30-year note broke the psychological threshold of 5%. I think that is significant. Now, again, this could just be morning repositioning. So it will certainly be something I will be watching likely all week. Is the Sell America trade, is it starting again? Is it more significant? Could this be something that forces the Fed to intervene? If this becomes unruly and continues to build, it certainly could. Another thing I saw yesterday evening, so it would have been Sunday evening, is the Japanese market. The Japanese, I think it was the 20-year note was significantly higher in rate. So I don't know what's going on, but there seems to be some financial stress in the global market. So it'd be something that you and I will need to be watching for. Again, I will be talking with Taylor from Life Goal Investments, 12-year Wall Street veteran, in about a half hour, and this will be definitely a topic. On the flip side, good old Treasury Secretary Scott Bessent was out in force this weekend and telling everybody that he could that the downgrade by Moody's was a quote-unquote lagging indicator. If you looked into why Moody's downgraded the U.S. debt, is all about runaway debt. In fact, I think the straw that broke the proverbial camel's back was President Trump's big, beautiful bill. I don't know if you guys have looked into this. The All In podcast did a big talk on this. It appears that this big, beautiful bill will actually significantly raise debt, not cut debt. Now, there's always the talk that this bill will grow the economy and the only way to get rid of the debt is to grow the economy. And yeah, I get that story. But when you do the math, a positive 2 trillion or whatever it is, that's not negative. That's not Doge doing its thing. That's not this. That's not that. So again, I don't know what's in the big, beautiful bill. It seems like no tax on tips. It seems like bonus depreciation. It seems like a lot of things that will be positive for the economy. So maybe we hope for growth. But I do think it's kind of interesting that no politician really has any interest in seriously lowering our debt limit. In fact, nobody in Congress has interest in lowering debt, as David Freeberg talks about all the time. There's just no motivation. So it is a sad state of affairs, if you ask me. The one topic on the All In podcast that did catch my attention this week was once again the talk of monetizing the U.S. balance sheet. I don't know where you come down on this. It certainly seems an interesting idea where the United States, who owns a lot of assets, clearly somewhere they argued between 100 trillion and possibly 300 trillion. If we started to monetize our balance sheet, this could be some way to get the debt down. I don't know about you, but at some point, all options need to be on the table. This runaway debt limit seems unattainable, and it will end badly. It will end badly. Now, the question is when? My lifetime? Probably. Hopefully I live that long. Certainly my daughter's lifetime. But again, this is not getting better, in my opinion. Let's congratulate some people for joining school. The last 48 hours have been great. We've got Kenneth, Ashley, Eduardo, Jeffrey, Alejandra, and Mary Lee. All have joined school in the last 24 or 48 hours. We also had our session on Sunday with Adrian Hernandez. Unfortunately, the recording bombed when I tried to download it from Zoom, so no recording, unfortunately. So if you missed it, I apologize. It's certainly not my intention, but technology bit us in the butt this week, so we will try again next week. We also had the accountability group run by Jared. Again, if you're not a part of the school community, what are you doing? We also have our we just had our 7th accountability group launch. I think it's on Thursday at 2 p.m. Pacific. Multifamily. We now have folks, Nima and I believe someone else, sorry, I forget your name, running the multifamily accountability group. So again, we have 7 accountability groups. Join the one that you want to be a part of. Join multiple, whatever you want, it's there for you. But Jared's accountability group talked about out-of-state investing, DSCR loans, private money, bathroom and kitchen remodels and returns. Again, all great stuff you should be a part of. We do get some Fed speak. Remember, as we talked about yesterday, I think there's 11 Fed speeches this week. I picked up on 2 already, Bostic and Williams. More to come tomorrow. Fed President Bostic leaning towards 1 rate cut this year. Fed President Bostic, should be noted, is not a voting member this year. However, he does carry a big voice. Again, leaning towards 1 rate cut this year. We need time to see the impact of tariffs. The reduced tariffs are still definitely economically significant. Again, I think the average has gone from 23% to 13%. 13% is still highest in 95 years or something. So again, still economically significant. And then finally, Bostic said, need to wait 3 to 6 months to see how uncertainty settles. Folks, I'm still of the same opinion I've had all year. No rate cuts in 2025. Note, I said that when the market said 5 cuts coming. Now the market says 2. Bostic says 1. Thankfully, I've held firm on my 0. Next up, Fed President Williams. The Fed can take its time. The economy is likely to slow this year. Watching debt delinquencies closely. Many firms and households are wait and see mode, folks. Stagflation. Lots and lots of stuff going on. Not sure if you're a Michael Burry fan, but if you are, you should know that at least in Q1, he went super negative. He sold 12 of his 13 stocks. The only one he kept was Estee Lauder. He sold 12 of the 13 and then went short. He bought puts. He went negative. He had a $97 million put option on NVIDIA for 49% of his portfolio. Michael Burry is very concentrated when he makes moves. His next biggest put position was in Alibaba for $26.4 million or 13% of his portfolio. Again, folks, never forget that when you see these filings, it was Q1. Michael Burry could be out of these positions by now. He could frankly be long now. These are not accurate current positions, unless he's come out on X, which I don't think he has, and said, yes, I'm still holding. These were Q1. He could have been in and out of these trades already. Never forget that. Robert Reich is in front of the camera again, talking about tariffs could signal a decline of the American influence in the world. You know, I don't think it's the tariffs specifically. I think it's the message. The message, the delivery, it was handled poorly. Frankly, there's that one President Trump's advisors, Navarro, I think his name is. He needs to go. I don't know what the heck he's doing there. He is not good for America, not good for the president, in my opinion. Let Scott Bessent, even Howard Lutnick is better than Navarro on messaging. Woo, gosh, what are they doing? Next up, we've got the admission that trade tensions will drive consumers to cut back. This is what I've been telling you the last month or so. Just when the consumer is scared, nervous, they sit on their hands, and they're doing it in a big way. I think we'll know a lot more on Friday. I think if I remember correctly, Friday is pending home sales. So it's existing home sales. I stand corrected, existing home sales. So we'll know in a big way. Existing home sales this week is going to be interesting because April was ugly. I think the experts are still calling for like 4.1. I think it'll be under 4 million, but we'll find out on Friday. There was a bank rate survey that says 54% of Americans, yes, 1 out of 2, are cutting back on travel, dining out, and live entertainment. I can tell you, having been in Vegas for a while, I have not seen the Vegas Strip or the Vegas restaurants and shows this empty. It is definitely hitting Vegas. I don't know if I talked about this yesterday, but just in case, Dick's Sporting Goods is out there buying Foot Locker for $2.4 billion. I thought that was interesting. Anything else to highlight here? Oh, yes, Regeneron is buying the bankrupt DNA testing firm 23andMe. I don't know if you ever had your DNA tested by 23andMe, but it looks like Regeneron will be the owner of that DNA, I guess, sequencing or whatever it is, if you haven't removed it from 23andMe. So just thought you should like to know that. At the end of the day, folks, like, subscribe, comment. Don't forget that our sponsor, Steadily, is Landlord Insurance. They are a focused organization just on landlords. They have personally helped me, most recently with a fourplex, saving me over $1,000 as they allowed me as a landlord to have more options on deductibles. Heads up, they saved me $300, apples to apples, but then when they allowed me as a landlord to be more picky on my deductible, willing to have a higher balance, which the other organization was not, I was able to save $1,000. And again, when you have, I don't know, dozens of properties, $1,000 each is not small potatoes. So again, do yourself a favor, get a quote. They are not for everybody. They do not cover the entire country, but they will, possibly save you some money, give you some better options. There'll be a link in the description below. Check them out. Take care. Later.